Welcoming you all for this wonderful session with Mr. Surjitt Arora from PGIM. Welcome you, sir. So
thank you for having me on your show.
Yeah, so thank you. And we have set up questions to ask him. So let's start off with the very first question. So we are moving into the end of the financial year. So we are moving into the next financial year now. So what are your key learnings from your previous financial year?
So basically, as you rightly said, we are almost at the edge of closing this fiscal year 2023. And the biggest learning for us from an equity market perspective is that we have to live with uncertainty, right? So last year we have seen whatnot. We have seen Fed increasing the rates big time. We have seen Russia-Ukraine war starting. We have seen commodity prices initially going through the roof, and now they have been correcting. So end of the day, equity will be an investment arm where uncertainty is here to stay. And because of the uncertainty, the volatility also in the market will continue to be as it is the way we saw last year. So the biggest learning for us as fund managers is basically to be cognizant of the fact that we have to be able to take care of all the risk in the market, specifically the volatility in the market. Having said that, we also have to look into the fact that we have to protect the capital of our investors. So hence, given the fact that we are going through a very uncertain environment, a lot of situations are very, very fluid globally. We have to be very, very sure of what we are getting into in terms of deployment, which sectors we are getting into, and what kind of allocation we are giving to sectors which are very, very highly valued in terms of P multiples or EV/EBITDA multiples. So we have to be very cognizant of the fact, given the environment where we are in, not to get overboard and not to chase momentum, and be very, very sure about which sectors and which stocks we are getting into for our investors.
So we'd say that market being very volatile.
Yes.
So what are the sectors that you are overweight on or bullish on for the next financial year?
Yes. So if you look at both our portfolios, one is core equity, which is a multi-cap approach, and one is Phoenix, which is a small and mid-cap approach. In both the approaches, three big sectors where we are quite overweight. One is industrials. When I say industrials, it includes your bearing companies, it includes capex oriented companies, it includes defense companies. So basically, Make in India as a theme, I think will do wonders over the next 1 to 2 years. So industrials as a segment, we are quite positive on. The other sector where we are quite positive is autos. So autos has seen a decent demand uptick. At the same time, now with raw material cost also declining or being more stable, I think the earnings profile of auto companies will be quite reasonable for next financial year. Apart from that, the third sector which we like is more to do with residential real estate, and we are playing that through building material theme. So we believe building materials as a theme could again surprise on the positive from an earnings perspective in FY24.
Okay, thank you. Being this a volatile market, what is the strategy that you follow as PGIM? What is the strategy that PGIM follows? Do you have any dry powder increasing or cash levels? No one wants to take big risk now because the market, people are coming for profits. If they don't want profit, they're moving out. So yes. What are your strategy in this current volatile market?
So as you rightly pointed out, I mean, we have been, managing these funds for quite some time now. And last 2 years have been quite difficult. Believe me, small and mid-cap investing has been quite difficult in last specifically 18 months, right? The good part about PGIM, and I will come to a process in a minute, is that in last 18 months, we have outperformed the benchmarks and we are in top quartile in terms of performance. So as I alluded to earlier, our objective as PGIM PMS is to protect the capital of the investors. Now, how we go about that, it's very simple. We have 3 to 4 parameters which we look at while selecting a stock. So quickly, if I give you the flavor of that, one is we look at the history of the company, at least 15 years of history. The track record is very, very important. Then we also look at consistency in terms of cash flows. The third parameter being return on capital employed. So depending on industry to industry, the companies which are better in terms of return on capital employed over a 10-year time frame become a part of our investment universe and hence are part of our portfolio also. And fourth thing, which we surely look for mid cap and small cap companies, is promoter skin in the game. So if promoter is having at least 40% holding in the company, then it gives some comfort in terms of their intention, or let's say their objective of driving the company. So these 3-4 parameters go into selecting the stock. And what at PGIM we have done so far so good is that, one, our portfolios are quite differentiated. So when you look at any benchmark, our portfolio overlap with the benchmark is less than 20%. So one is it's a differentiated product. Second, it's a slightly concentrated product. So in both our strategies, today our average holding is around 20 to 21 stocks, and the top 10 holdings will account for almost 60%. So I'm a firm believer with my experience that wherever conviction is higher, it has to get reflected in the portfolio of the clients. So we have to allocate minimum 5 to 6% in a particular stock to show our conviction in that particular client's account. And last 18 months, that is what has happened, where out of top 10, 6 or 7 companies out of top 10 have performed very well. And because our allocation for these companies were at 5 to 6% on average in terms of weights, it helped us in terms of outperforming these strategies or outperforming the benchmarks.
Okay, thank you. One more question that would strike everyone's mind right now is about the financial sector. So globally, they are under crisis. So joining the account, we have Silicon Valley Bank, Signature Bank, and Credit Suisse Bank. Everyone are under pressure. The global banks are under pressure. So what do you think the impact will be in Indian market? Because do you think the bank nifty will suffer more, or do you think we are a bit resilient part of it?
So in our view, our banking industry is quite resilient, and kudos to RBI given the checks and balances here. So just to quote some data points, right? So if you look at global banks, there the mix of deposit was more towards wholesale deposits, whereas in India it's the other way around. We have a lot of retail deposits. So that's point number one, which is more sticky in nature. Secondly, if you look at the NPA cycle, let's say the gross NPAs, which peaked in 2018 at around 13% on the banking level or the industry level, they are down to 5%. Third, the provision coverage ratio for majority of our banks is very, very high. So we are sitting on a very decent P&L and balance sheets. And fourth is the CASA deposits. Again, these are low cost deposits. Many banks are sitting on 40 to 50% CASA deposits. So if I look at all these 4 parameters, and in context of the rising interest rates which we saw globally, India is relatively immune simply because our yields or our interest rates have gone up only by 200 basis points on average. Whereas let's say if you put Fed into perspective, they went from 1% to almost 5% now, right? So the steepness in terms of the rate increases has been more steeper in US and European economy versus what we have seen in India. So given our balance sheet strength, given our NPA cycles, and given the provisioning at the banking level, I think we are much more resilient. And hence, I think Indian banks will do relatively better compared to what we are seeing on the global level.
But with saying that Fed is not going to immediately close their interest rate hikes, it might continue for the next financial year as well. Because so do you think that was going to impact a D Street?
Frankly, I have a slightly different view. So if you look at the Bloomberg data right now, in the last 1 week or so, after unfortunate collapse of these banks, both in Europe as well as US, the bond markets globally are indicating that Fed by end of this calendar year might resort to cut in interest rates. So as against a quantitative tightening, the bond market is a very good parameter to judge what the sentiments and what the street is assuming. So at least when we follow the global data and we do our research in terms of Bloomberg data and all, we believe that at least the global bond market is hinting that Fed, instead of further quantitative tightening, maybe as you rightly said, there might be 1 or 2 more hikes. But when you come to near to CY23 end, we will not be surprised that Fed resorts to quantitative easing, given that the stability of financial sector, specifically in US, is now the more priority for Fed compared to just controlling inflation. So it's a very catch-22 situation. But my sense is, given what globally the data points are indicating, we might not be surprised that by end of this calendar year, you might see some rate cuts happening in US.
Okay, that was a different view. And one more thing, like coming back to your portfolio, your Phoenix as well as your core equity portfolio have beaten their benchmark in previous financial year. So, what was the secret mantra to produce alpha in spite of market being volatile?
So as we discussed earlier, right, I firmly believe that the conviction has to be reflected in the portfolio. So because we were quite convinced on the stock picking ability given our research team, we went all out with 6-7% allocation to our top holdings in both the funds. And because we were overweight, let's say if I talk about core equity first, because we were overweight industrials and underweight IT and financials. So if you look at last 1.5 years, both IT and financials have not done much. They have underperformed. And luckily for us, we were underweight on both the heavyweights in the benchmark, right? So because of IT being underweight and banking being underweight, and on the positive side, we were overweight on industrials and building materials, that kind of alpha was generated on the core equity front. When I look at Phoenix, which oriented approach, their majority of our mid and small cap companies were debt free, and as I alluded to earlier, the promoter skin in the game also becomes a very important part. So majority of the companies were having minimum 50% plus promoter holding, being debt free companies, and the runway to growth for them were relatively better when I compare to the overall market. So I will say yes, it's about a process, it's about a hard work, but a little bit of luck also favored us, where our top holdings did very well. We are cognizant of the fact that this kind of outperformance might not last. So we are constantly looking out for better opportunities, better alpha generation, and wherever we believe that the valuations are at a stretch and we have made decent money, there we are partially booking our profits and utilizing that cash to again redeploy in some other stocks where the potential could be better than what we have done in the past.
Okay, kudos to that. And what do you think is a unique selling point of PGIM that differentiate PGIM from others?
So again, to my first point, right, our portfolios are quite differentiated. So when you look at the benchmark, or when you look at the other PMS products in the market, we do this exercise monthly. So our overlap with our peer set, the overlap is hardly 15 to 20%. So one is a differentiated product. Second, again, as I told you, we have a research team of around 8 people, or are at least 14 to 15 years experienced people. So we get a lot of inputs from them. So given our research team, given our process and the differentiated product itself, I think that are the biggest selling point for PGIM PMS.
Okay, thank you. With that, we come to the end of the session. So, thank you for being as a guest for this wonderful session for the audience. It gives you a view of the next financial year as.
Thank you so much for having me on the show. Thank you so much.